Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. So recently I have been getting a loads of requests to look at individual stocks, and I've got about 5 or 6 of them on my list to potentially cover between now and Sunday, inshallah. So that's what I'm planning to do. I've got about 3 of them planned already. This is the first one. So what we're going to do now is I'm going to give you a little bit of information about the business. Then we will look at where historically where the company has been. We will look at the future expectations when it comes to earnings and so on. Because remember, earnings drive price. If the company is doing well, if they are expected to earn good, money from their whatever their goods and services, then potentially the price will go up, and that's basically what you hope for. And as an investor, you want to see growing revenue, you want to see growing EPS, and of course a company with an excellent free cash flow, especially at this one where it has, of course, does pay growing dividend. So let's have a look at the company. And as always, I'm not a financial advisor, I'm just giving you my opinion. I'm not covering every single aspect about this business. So just do your research, of course. And the company we're talking about today is Home Depot. Home Depot is down a year to date, is still down, whereas the S&P 500 I think is about 13% up. For the 1 year, about 7% down. For the last 6 months, it is up about 12%, which is nice. But a year to date, so since the beginning of the year, is actually down up less than 1%. And if you haven't come across the company, they are one of the biggest retail companies in the United States. Home Depot and Lowe's basically work with a lot of professional builders and do-it-yourself builders and so on. They've got branches every single state, in every single city in the United States. They're a huge company. The last year they made 159 billion in revenue side of things, or in sales, and the year before was 152.7. Last year was 159.5, which is quite good to see, because that means it's still growing. 13% when it comes to adjusted operating margins, and then return on invested capital, we're looking about basically over 30-something%. So it's a great company. It's returning value to shareholders and so on through buybacks, and I'll show you the buybacks and things like that in a second, and as well, of course, the free cash flows and so on. Now I'm going to focus on where the company has been, because I just want to explain a few things about the fact that, right now we're in a situation where the stock market is no longer undervalued at this point in time. It seems very, very much overvalued. And I just want to show you there are companies within the S&P 500 that has been, overvalued at a certain point, and when I just want to show you using fast graph when the best time was for you to buy this company. And look at this. So this orange line here is the operating earnings at 15 PE, and this is what Mr. Market likes to trade when it comes to basically this stock. This line here is the dividend, and as you can see, it has been growing over the last whatever years, and it's expected to grow over the next couple of years. Now I'm going to add the actual price, because remember, when it comes to price, it should be, ideally, you should be buying this stock when it's on this line here, the orange line, or slightly below that line. Because the below that means it's undervalued. On that means it's basically right in fairly valued. This is what Mr. Market has been basically trading this company for the last whatever years, and as you can see, it's always been valued at had a valuation of premium valuation, if you like, over the last whatever years. So since 2006, the company has not actually gone anywhere near where the operating earnings has been, which is quite interesting. And this is one of the reasons why I have not added to this company for a very, very long time, because every time I look at the valuation, I realized it is still overvalued. At the time when I bought it, it was just straight after COVID, and I'll show you exactly when we add the price. So if we add now the price, look at this. So the price of the stock supposed to be following this orange line here, but it hasn't been. It has been over that for a very, very long time, and then COVID happened. It dropped to 14.5 PE there we go, 14.5 PE in 2020, when March of 2020, when COVID happened. if you bought this stock around that time and you hold it up until now, check this out. You would have made, if you invested $10,000, you would have made $28,284 or 182% up right now. So that was the best time to buy. The worst time to buy the company would have been 2021, December 2021, because if you had bought the stock there and hold it up until now, you would have lost, well, you would have gained about 1%, if you like. So it is not, because it's still overvalued. But if it comes back to reverse to the mean, if you like, okay, goes back to the price we expected it to be in the next 2 years, you will be losing about 22% right now if you bought this stock around that time. If you bought this stock right now, and we will look at the valuations from other companies and so on, but just to look in the fast graph, you can see you'll be losing about 11% every single year for the next couple of years if you were to buy this stock right now. Now, if we reduce this, okay, so this is the earnings, operating earnings. We got the fair value there. We got the normal PE, which has been about that 20 for the last whatever years. The company has blended PE of 25. It has EPS of about 4%. EPS yield that is about almost 4%, and dividend yield of 2.37%. Now, if we reduce that to the last 10 years, and we just get rid of this line here, or even just to the last 5 years, you can see the difference between where the stock is right now and where it should be. And if we use the forecast for this company moving forward, and we're looking about that 9% in EPS growth for the next couple of years, about 10% there. If you were to buy this stock right now, you will be losing, like we've seen already, that you about 11% every single year. Now, if we use the normal PE, which is basically what the market has traded this company over the last whatever years, then you are making about 5% per annum moving forward. Okay, so your 10,000 will become 11,222. So it is still seems overvalued based on this growth. Growth is not a lot, and sometimes you might want to buy stock thinking, do you know what? Because the growth is there, it is slightly pricey, but I feel like it can go higher. Right now, there's nothing pushing this. There's no tailwinds for this company that's going to push forward with regards to the price side of things, because this growth is not massive at all, and that's something that we need to have a look at now. So if we go to earnings expectations moving forward for this company for the next few years, you can see that we've got about 8%, 9%, 7%, 8%, nothing huge at all. Although there's a lot of analysts looking at, if you even focus the first 4, that's basically negative, almost negative growth this year. So by January this year, the company has not done anything. And this is what I was expecting this year, the stock to come down, because I knew there was literally zero growth this year. And I was hoping that because of that, the stock price will come down and it will give me an opportunity to buy more. But that didn't really happen. So 8% for the next year, 9% for the following year, and then 7%. There are companies that are trading almost a slightly lower PE, if you like. This one has, let's see if the forward PE for this company, about 25. There are companies that have a better growth that are also slightly lower. In fact, I'm not comparing like for like, but let's see Nvidia forward forward PE, if you like, 30, almost a 4. Okay, that's a bit extreme. Maybe we can compare with other companies. Let me see. Let me just kind of add like 28 when it comes to Intuit. And if we check the Intuit, for example, right? And remember Home Depot was 25. So look at this. This one is slightly got better growth. And again, this is one of the companies we will be looking at soon, inshallah. But yeah, it has a better growth, but at the same time, almost the same PE, if you like. Now, the couple of things that we want to look at now we sort of look at the valuation straight away and where the company has been. So we have an idea of the fact that it could be overvalued at this point in time. But let's have a look at the financials, and then I'll share with you guys my discounted cash flow model and where I think the price should be in the next few moving forward, if you like. So we've seen the dividends already. It seems reasonably valued according to the dividend theory, if you like. I'll show you in a second. It has a very safe dividend and a credit rating of A, which is strong. Okay, 385 billion market cap. So it's a huge company. Okay. Dividend in terms of the payout ratio is only 61%. We want to be, we want this to be slightly lower, of course. And the latest increase was 2.2%, which is not great, but at least for the last 5 years has been over 10%, which is quite nice. Over the last 10 years we're looking at about 16%, and that looks really nice. Since 2016 you can see every single year they've been growing it massively. 16 years of increasing. $9.20 is what you get for every share of this company that you own. And if you look at it right now, we say normally that dotted line, if it's above this, sort of a blue line here, then that means it's overvalued. If it's under it, that means it's undervalued at this point in time. But right now it's sort of a fairly valued, so that's why it says reasonably valued at this point in time. But again, we wanted to come down quite a bit to see that, of course, slightly lower than that. Now, if you compare the last 5 years, so the average PE for the last 5 years has been 22.6. Right now it's 24.7. So it is expensive on that. When it comes to, like, in terms of dividend theory side of things, 2.4 is where it's been over the last 5 years. Right now it's 2.37. It should be, it's basically the fact that it's lower than the way it has been, that seems it's a little bit overvalued at this point in time. Again, the company is, in comparison to the sector, which is about 16 PE right now, it seems very expensive. Like I said earlier, the payout ratio, we want it to come down. The free cash flow also payout ratio, we just need that to come down as well. But earnings per share has been growing really nicely, especially 2020, coming out of COVID. A lot of people were locked away in their houses, doing a lot of renovations and so on. And then, of course, we've seen the dip 2024, 2025. Has also dipped it slightly. 2026 we're expecting it to be more or less the same as this year, but 2027 is slightly higher. We've already seen that. Free cash flow per share is also similar. If we look at the shares outstanding, this is where the company is doing really well and the management doing great job. However, I don't like when management are buying the stocks shares back, especially when the stock is very much overvalued, and it's been over the last 5 years, but they have been buying shares, which is fine, okay, but I really would love the company to use that money for something else rather than buying the overvalued shares. And the total sales, as you can see, from 88.5 billion to right now $165 billion, which is absolutely massive if you think about it. Return on equity right now is 194, return on invested capital 23, operating margin 13%, and a free cash flow margin of 9%. Debt levels is quite low, which is quite nice to see. Normally anything below 3 is basically what we're looking for in this one. And looking at the performance of this company against the S&P 500 only, I'll share with you in a second, in comparison to lows and so on, over the basically since 2005. Okay, this is the S&P 500, this is the company. The company has returned 12.3% over the last since 2005, and the S&P 500 about 9%. So it actually has beaten the S&P 500 over the last 20 years, if you like, which is really good to see that. Okay, but again, that doesn't guarantee that's what's going to happen next few years. And if we look at it in comparison to lows, for example, we've got lows here, and we have and Floor and Decor as well. The three companies are very in a similar industry, if you like, and then we've got the S&P 500. If we look at, say, let's look at the last 3 years, for example, this, Home Depot returned, let's call it 49%, the S&P 500 80%. The Lowe's was about 32%, and this one was flat, if you like. Okay, this is total return, including dividends and price appreciation. For the last 5 years, for both companies, 52%, 90%, 50%, and then this was flat. For the last 10 years, 293% against 220%. So it's done well over the last 10 years against the S&P 500, and you've seen the last 20 years has actually done better. Okay, but Home Depot has actually done similar sort of as well, and this one is about 118%. So it is a great company. It's a very cyclical business, of course, because of the renovations and stuff like that. People don't do that on a weekly basis. If the economy is doing well, people are buying houses, renovating their old houses, this and that, the company will do well overall. So, and the reason I think people are asking right now is just to see, the fact that 41 years actually in the negative and year to date is flat. So everything else is gone up about 13% minimum. The S&P 500 might be the 13%. Everything else is 20-30% up every single thing, right? but this company is flat. So that's one of the reasons I think people are looking at. But if we look at the valuation is moving forward, Morningstar is saying $335 per share is where they think the price should be. Current price is $387. Simply Wall Street is actually saying $295 per share. Seeking Alpha analyst, when you basically combine and give the average, $438. I used the dividend discount model that gave me 326 and discounted cash flow model of 382, and I was genuinely being sort of cautious, especially. Okay, so that gave me 382. So when you average all of that, you end up $355 per share, which basically means the stock's still overvalued. So even if you give yourself, say, actually this one is probably safe one, so you can say, oh, you know what, I'm going to give myself 5% off margin of safety, and inshallah, you know, if anything happens, at least I'm covered. So you can buy this stock at what, 335, 337. Right now it's 387. So if we see a massive pullback overall and something happens in the market, then potentially you can add this one. Look at this one here. I'm up about 30% since I bought this stock. I think I own about 16 shares or 14 shares if you like. I've not bought a single stock. Let me just click history side of things, and I'll tell you when I last bought this stock. All of this is just dividends. Literally all of that is dividend. Okay, the last time I bought a share of this company was, when was this? Okay, 2023. So I haven't actually added to this company for the last 2 years. So this was March 2023. So I have not bought anything since then. At the time, it was $284 per share. Maybe I wish I bought more at that time, because now it's almost double that price. But it doesn't really matter, because I'm going to stay disciplined. I'm not touching this anytime soon. It seems overvalued. If it comes back to even 300, I will definitely be interested, because 287, yeah, then I will definitely be interested. But right now, it seems overvalued. It's a great company. I really like the business. Very stable. Doesn't have a high beta. So inshallah, we'll get an opportunity in the next few months, whatever, and we'll see what happens. To be honest, if the market continues doing what it's doing, which is basically one day is up, next day is up. So today today is Friday morning, so they expected the earning once the market opens. Look, companies like Broadcom is down about almost 4%. There was a couple of others. Look at Novo is actually down about 4%. Eli Lilly is down over 5%. So we'll see what happens overall. So it's very volatile stock right now. We might get an opportunity in the next few months. So you never know. But that's the first company I want to share with you guys. There's another 4 I want to share, inshallah, before the end of the weekend. By the time we get to Sunday, inshallah. Have a wonderful day. But before you move on, if you can press that like button, that would be absolutely amazing. And of course, join us in the Patreon account where you get access to a lot of things. Have a wonderful day. Assalamu Alaikum.